Okay, so
we're live.
Yeah, we're live.
We are.
Great. Dennis, you begin?
Yeah, I think we just let's wait. I think we have people joining now. I see it's a group because we just open it up. So cool. Just 1 minute, I think, and we can start. A second, the system is uploading. Yeah.
Wow.
What's he doing? Just well, give us a few more seconds. I think just wait a bit more people to join. The system just uploading everyone. Okay, so sure. Okay, Ryan joined as well. Okay, so we're all set.
Think so.
Yeah. Okay. Well, thank you very much, everyone, for joining. I mean, this is our first online version of meetups, which basically we've been doing before in Berlin, and we just wanted to give a sort of very short introduction to the actual concept, which was started back in August last year with the meetups jointly with Alejandro from Poland, just as a sort of a meetup place for a professional audience who either come from a mining space or interested in the mining space itself. And we've been doing sort of a free offline, we call it now, sort of a meetups on the different topics, which basically of a concern maybe or of interest for this audience. And this is our first sort of online webinar, which basically we just want to focus on the things that we want to highlight. Sort of three main points. What we see is some of it's just building awareness of the actual sort of mining space, because for unfortunately we still see a lot of messages in the media. Sometimes they do not represent a true picture of a fundamental part of actual Bitcoin mining itself. And also it's just to allow the mining the miners to interact between each other, to see or share concerns, to see the trends, and also for the other sort of segments that we see is a lot of growing interest is more for professional services, trading, sort of financing, sort of companies and anyone basically that is interested basically to get exposure to the sector now at the moment. So that's an idea that we had behind this. We picked up the three sort of the topics that we have at the moment for this agenda. As one is basically that everyone's basically talking about this upcoming halving for the BTC, and also just want to make a reference that we saw some things that to with Bitcoin Cash and the cover actual landscape, how we sort of see it from a professional audience. Second point is basically something that we want to add to as an awareness for the mining the whole community is basically that let's say the regulation and more sort of compliance requirements coming through, and we see it more, let's say it's not a threat, but it's let's call it a regulatory adoption of this the Bitcoin. And the third is probably the most sort of interesting for the miners, which is basically was the biggest challenge I think for the sector. Even though it's the Bitcoin mining within the BTC ecosystem is the second biggest after the trading, it's for some reason it was neglected, and especially neglected from in terms of financing. And I think this is one of the issues we just want to address as a part of this webinar. So allow me to pass on to the point sort of first of our agenda with Alejandro that can take over the discussion there.
Hello, everyone. Thank you for joining. Thank you, Dennis, for the introduction. So let's move on to first topic. The first topic is, of course, what happened recently was the Bitcoin Cash, Bitcoin SV, Satoshi Vision halving. That will be the first topic we'll discuss. And we'll also be discussing about the halving of Bitcoin in May, which is a very hot topic nowadays. And a lot of people are very interested to hear what's going on and what's the perspective from a mining pool, from miners like us. So I'll go ahead and start with the first bullet point. I think a lot of people were interested to hear about what happened with Bitcoin Cash, Bitcoin SV in the halving. What we saw was a definite influx of mining in the last week or so in Bitcoin Cash and Bitcoin SV, and then we saw an immediate drop off from hash rate from when the coins halved, and we did see an addition of hash rate into our Bitcoin pool for pooling and Bitcoin in general. However, you need to keep things in perspective. Bitcoin Cash and Bitcoin SV, the amount of hash rate, is low. It was around at one point, I think it was around 3.5 exahashes of Bitcoin Cash, around the same Bitcoin SV. And now we see about 1.5 to 2 on each of these coins. So around 1 exahash moved out of these coins. So it's a very negligible amount of hash rate. And although it's very interesting for everyone to, especially for us as pooling, for me, and for the other guys here, it's interesting to see how how things develop there. But to put things into perspective, it's an extremely small amount of hash rate. One mining farm in Bitcoin is bigger than the amount of hash rate that switched over from these coins. So it's very difficult to sort of take that event and then think that this might happen in Bitcoin. It's not in essence, it's not a reference point for what the Bitcoin halving will be. So it's Ethan, do you want to add to that?
Yeah, I think the really interesting part right now is seeing Bitmain prop up Bitcoin Cash still. So right now, the value of Bitcoin Cash is still about 20% lower than Bitcoin. So there's a huge opportunity cost Bitmain is throwing away here by putting hash rate onto the Bitcoin Cash network. So you're seeing that through Antpool, BTC.com, and via BTC right now. And so I think that really the Bitcoin Cash halving, like you said, doesn't have a huge impact on Bitcoin, but it is really interesting to see from, how much is Bitmain going to continue to support Bitcoin Cash moving forward? Are they going to carry it even when it's less profitable? So I've been looking at it from that angle. You've seen with Bitcoin SV hasn't been the same. There hasn't been that level of support. So more hash rate fell off Bitcoin SV. And now that profitability level is somewhere close to Bitcoin again, because there's just not as much hash rate backing that coin. So I think in the long term, you're going to see more tribalist miners on Bitcoin Cash. And it looks like Bitcoin Cash will end up, potentially outlasting BSV.
But yeah, that's a good point. Definitely something that we've seen. At one point, it was around 60% less profitable to mine Bitcoin Cash than it was to mine Bitcoin, and there was still around 1.5 exahashes in that mining Bitcoin Cash. So that is definitely a clear sign that someone was mining it at a loss just to prop up the chain. Now on Bitcoin SV, there was also a point where it was also around 50% less profitable, of course, because of the halving. And we did see also around 1 exahash mining that coin. So there's reason to believe that the people behind N-Chain or Craig Wright and their crew were the ones maintaining that coin. So it is an interesting point, Ethan, and it's something that it's difficult to see why they do that. I mean, I guess because they have a lot of interest in that coin, but Bitcoin doesn't have the same. Bitcoin doesn't have this issue. Ethan?
Yeah, it's just, I guess it's a balance sheet risk for Bitmain potentially. We haven't seen a recent filing of their balance sheet, but I'd assume they still hold some Bitcoin Cash. So if they're mining at a a loss in terms of opportunity cost, it could make sense for them because they think that it'll pay off in terms of their balance sheet. The other consideration too is that they're potentially not even mining with their own hash rate. So miners aren't really sure where their hash rate goes. It's up to the mining pool to direct it. So there could be miners connected to their pool that think they're mining Bitcoin, but really it's being funneled to Bitcoin Cash. In that case, there would be a loss because you're paying like a PPS rate for Bitcoin, but then you're only getting revenue for Bitcoin Cash, which is a 20% loss. So it's kind of unclear which hash rate is contributing to those networks, whether people know it or not.
Right. So let's switch away from BCH BSV. What kind of potential change do you see to the mining pool landscape, Ethan, after the Bitcoin halving in terms of smaller pools and big pools? And maybe we saw one pool, I think it was Valor Hash. They just recently said that they're going to stop mining Bitcoin, and they're just going to mine altcoins. What do you see there? Do you see this sort of developments like continue, or what do you think?
Yeah, it's hard to say, but I think there's a few things that we can speculate on. One, Dan Armitage put out a really interesting analysis measuring. He looked at the total hash rate for the pools divided by the amount of workers to determine what's the average hash rate per worker. And from there, you can start to get an understanding of what generation machines pools are weighted towards. So his analysis pointed towards Via BTC being a pool that's weighted mostly towards S9s or really old gen machines. You can draw some interesting conclusions from that, thinking that, okay, if you're weighted more towards those old gen machines, you're going to have a larger hash rate drop than a pool that has more miners that have S17s or M20Ss. So I think the pools that have historically done well with S9 miners, those pools are probably going to lose some hash rate. In regards to that Valor Hash announcement, basically they closed Byte Pool. They shut it down. They also run another mining pool called 1T Mine. So it is a little bit of a confusing announcement that they made. I think the big point here is that, this to Alejandro, like running a mining pool is a tough business, especially when you run it on a pay-per share method, because you're taking that variance and luck. So if your pool is either, not built on the best code and you're orphaning blocks or have high invalid rates, or two, if you have high invalid rates, then that's potentially an issue where that pool will have to close. So with the upcoming halving, that's just going to make the problem worse, and it's going to make the economics behind running a pool a lot tougher. So I think we'll see a couple more closures because of those.
And another thing, I get this question a lot, especially recently, is what will mining farms be shutting down now that the halving is coming through, and what will happen to mining pools? Well, I think it's the same exact answer for both mining farms and mining pools. If a mining farm or a mining pool hasn't, been preparing for this event already for a couple months, maybe even a year, and doesn't have enough cash flow, and it's just business 101. You need to have cash flow. You need to look into the forecast. You need to forecast for this event. I think mining farms that have already switched to stronger machines and that have paid off or have cheaper electricity will, of course, be able to survive the halving. And same exact thing goes to mining pools. If the mining pools have been saving up and stocking up on Bitcoin or cash just to run the business ahead of this halving, they'll be fine. If they that's the reality of the game. I think a lot of the big mining pools will be able to maintain. They will lose. We do see some hash rate leaving the network and a drop of hash rate, but if you're not prepared for it, then it's your problem, basically. And I think most mining pools in the top 10, at least, including probably yours, Ethan, already have this in mind and already have plans to maintain the pool business running for at least a couple more months until everything gets back to normal and things normalize. Now that brings me up to like, what is the expected hash rate and Bitcoin price after the halving? I think, like I said, the hash rate will drop. This is due to a lot of older generation machines that will no longer be profitable, and of course it's very hard. It's always very hard to give anyone a concrete answer, because each mining farm and each pool has its own issues and challenges and has its own way of doing things. So it's one mining pool or one mining farm might have new equipment that they just bought, and now this halving comes in, and then they won't be able to pay off, and then they come into a lot of issues. Or there's another mining farm that bought new equipment a long time ago and already paid off at least a lot of it. So it's very hard to see what will happen in these particular cases. But older generation machines will be unprofitable unless they're mining in extremely cheap electricity, places where electricity is very cheap. And then the Bitcoin price, I don't tend to speculate. I think people might see the hash rate falling as a bearish sentiment, and some people might freak out, but I don't know. Ethan, what do you think?
Yeah, I mean, I agree with all your points. I feel like we say this in every meetup now. There's going to be a large hash rate drop. It's just a matter of how much. And I think Chris has done, incredible work, like looking at this, looking at, educating people on the difficulty adjustment algorithm that adjusts every 2 weeks based on hash rate. So I think it's a beautiful part of Bitcoin, what makes Bitcoin so great. So we're going to see that hash rate drop. We're going to see that difficulty level drop following that, and then it's going to bring back some miners back into the game. But likely we'll see like 30% drop in hash rate right now, based on current profitability levels.
I just want to like finish off this whole, I think we're all in agreement that the hash rate will decline, will decrease after the halving. I think also it's a great opportunity for new players to come in. That's something that no one's really touched upon. I think if have been looking into mining and have been considering it, now after the halving, it's a great opportunity to jump in. First, the hash rate will be lower. 2, there's new machines in the market. 3, which will be touched upon in the next topics. There's a lot of new ways to finance your operation, a lot of new instruments that you can use to hedge your risk. And for the next 4 years, that nothing's going to happen to the amount of Bitcoin coming in every block. So it's something that I have been stressing a lot. This is also a very good opportunity for new players to come in, and it's going to flush out all the inefficiencies of older players. So ultimately it brings in new players. I think it's good. I think it's good ultimately. Denis, Denis, you want to move on to the next topic?
Yeah. Sorry, I just had to upgrade because we had a limit.
Oh, the capacity.
Yeah. It just
good problem.
Sorry, let me just see what we can do. So this is something where we basically took an initiative adding on, taking into account that, let's see, with more regulatory sort of interest in the digital assets, obviously that what we see at the moment as part of this adoption of BTC, we clearly come across a traditional sector. I mean, we obviously come across the banking or any other sort of counterparties that used to work with with certain rules and requirements. And one of these big ones is obviously the compliance side. That's why all of these letters we put there, I mean, just to confuse everyone, but at the same time, just to say that basically this is what is coming our way, and we already see it, because I think the recent study, which was released by in Europe, which basically says, okay, they're going to be focusing on more on actually mining as well, because previously it was left out from, let's say, the scope. Everyone was focusing on the trading platforms and to see in terms of the compliance with the original funds in the flow. But this is also coming towards the mining as well. And that's why we want to just make an awareness of that. And also just to show that let's say it's an instruments which already exist, and this is where we basically want to discuss in this topic, that there is an instruments that already exist on the market that can be adopted by the institutions, you know, and even by the miners, because especially if you're interacting a lot like on the trading flows and basically with different counterparties, where actually you can limit your exposure to this potential risk of some illicit activity in the crypto that can come into the direction of your wallets. So let me pass this to Dirk from Chain Analysis to present some of the solutions that basically we are using as well. Yeah.
Well, thanks a lot for that introduction, Denis, and thanks to everyone for attending. I hope you're all staying safe and well and socially distanced. I'm going to try and share my screen right here because I did put together a few slides, so hope you can see it, but holler if you can't. But really what I want to kind of cover quickly is, oh, no, that's not what I want to do. Really what I want to cover quickly is you guys are hearing a lot about different terms, FATF, fifth AMLD, but what does that really mean in practice? What proactive measures can cryptocurrency businesses such as mining pools take to make sure they are abiding by these regulations? And what are the real pitfalls that they should look out for? What are the illicit actors that are especially important when it comes to mining? Now, you know, the cryptocurrency industry, especially from its early days, it did have a bit of a negative reputation due to a lot of the high profile criminal cases, you know, BTCE, Silk Road, and that has meant that law enforcement agencies and regulators have viewed this industry with some suspicion. And that's one of the reasons we at Chainalysis, what we do is we try and ensure that there's built more trust in blockchain. So we try to provide compliance and investigatory solutions to compliance officers, but also to law enforcement agencies to ensure that this industry is viewed with less disrespect and there's more trust effectively across the blockchain. So what we effectively can do is we can map addresses to services. And by that, what I mean is, you know, if you look at the blockchain, you guys are all well aware that every transaction is made public. You know, you can see which addresses are sending funds to which addresses. You can see how much they're sending. You can see the date that they were sent. But what you don't see is you don't have a clear idea as to which entities are controlling which addresses. So what we can do is we can look at the blockchain like the Bitcoin blockchain and we can say, okay, these millions of addresses are under the control of an exchange like Coinbase or Binance, or these addresses are under the control of a mining pool like Poolin, or these addresses are under the control of a darknet marketplace, a terrorism financing group, a ransomware syndicate. So we can take that publicly available blockchain information and we can map that onto the real world to give cryptocurrency businesses real actionable data by which to conduct their compliance needs. And we actually looked at some of our data to see what we found for 2019, and what we found, it was actually the biggest year ever for illicit activity on the blockchain. Now, when I say biggest year ever, we're still only talking about 1.1% of all transactions being illicit. So it's still a pretty small share overall of every transaction being conducted, but it is still a 180% increase on the previous year, on 2018. And we're talking about $5.78 billion being sent and $5.77 billion received by illicit entities like darknet marketplaces and high-risk exchanges. And it's something we as an industry should be aware of. I decided to also look at our data to see how mining pools are interacting with the rest of the ecosystem. And what we find is that mining pools send the vast majority of their funds to exchanges, which makes sense because mining is an expensive activity. You got to convert your funds. But what we also find is, yes, exchanges get most of their Bitcoin from other exchanges. So Coinbase gets about, Kraken as well, get about 90% of their Bitcoin from other cryptocurrency exchanges. But aside from that, mining pools are actually the most important source of new Bitcoin flowing into exchanges. That's followed by host wallets and then by merchant services. And mining pools actually account for 28% of the Bitcoin that exchanges received from services other than exchanges since 2017. And you can see a little bit right here, you got Huobi kind of leading the charge here, OKX, you got Binance as well, Bitfinex, and then other exchanges. We have a full report on this I can share in a bit. But this is one area where exchanges, or rather mining pools, have to be a little bit careful because not all exchanges were created equally. So if I look right here, this is Reactor. This is our investigatory software used by law enforcement agencies. And effectively, I could look up any address or any service right here, but what I can see is I'm looking up livecoin.net, and Livecoin are what we call a high risk exchange. yeah, they're an exchange, but they're also known for having pretty much no anti-money laundering or KYC protocols in place, and effectively just being a source where illicit actors can dump their funds. And what we find right here, we can see their balance, the amount sent, received. I can see that they've been active since March of 2015 through to about present day. But here I see their exposure, which is just a fancy way of saying where they're receiving their funds from and where they're sending it to. So on the receiving side, I can see they received about $3 million worth of Bitcoin from exchanges. And on the sending side, I can see they sent about $6.5 million to exchanges. And these are everyday, regular, licensed, well-known exchanges, which is a little concerning because it means they might not be doing the requisite AML in place to ensure that they aren't interacting with these risky entities. But more specific to this conversation, I can also see that this high-risk exchange received $34,000 from mining pools. And this was from, the date range for this is about the last 3 months. Now, $34,000 isn't an enormous amount. It's only 0.34% of their total exposure. And what we actually find is that mining pools in general are pretty clean. They don't interact with a lot of illicit services. But $34,000 is still going to set alarm bells off to any regulator. And when it comes to complying to 5th AMLD and other regulations across the world, they would need to report transactions like these, and the regulator would need to be made aware that a risky transaction like this one has taken place. So this is something to keep in mind. So one thing mining pools and also cryptocurrency exchanges can do is monitor their transactions. So this is one solution we have called KYT, and it effectively allows services to monitor their incoming and outgoing transactions and receive alerts anytime a transaction goes to a risky source. So if you're working as a compliance officer, or you're working in a mining pool and you see that transactions have gone to risky sources, you can act accordingly. Now, mining pools also have to be careful that if an exchange wants to partner with them, that they are partnering with, again, a legitimate service. So what they could do right here is they could look up an exchange in Cryptos, which is somewhat of an encyclopedia of who's who in crypto. And let's say BTCE2PM.me comes to me and I'm a mining pool and they want to work with us. I can look them up right here and I can see, first of all, I'm getting no information, no legal name, no main office, no KYC policy. And that's primarily because BTC2PM are another high risk exchange. But what I can see that's more concerning is their exposure, their transaction volume. Yet I'm just looking at a random week in May here. I can see that 25% of their total volume went to exchanges, but 51.3% went to the darknet. So that means this is a risky service. There's no reason why they should be interacting at that volume with the darknet. So as I, as a mining pool, now know this isn't someone I want to be working with. And on the flip side, if I, as a mining pool, or if I, as an exchange, want to work with a mining pool, you can look up the mining pool in here, and you can also see what kind of exposure they have. You can ensure you aren't exposing yourself to unnecessary risk and working with these risky actors. So I know that was probably a lot of information to take in a few minutes. I think if there's a few key takeaways here, it's that yes, the vast majority of cryptocurrency transactions are legitimate, but risky transactions are still on the rise throughout the last year. And mining pools as well, they do inadvertently send funds to illicit services. So cryptocurrency businesses, mining pools included, need to ensure they have adequate AML in place to ensure they aren't interacting with risky services, and we can help ensure that this remains a safe, open, and transparent blockchain. So I hope that was informative. That's really all I wanted to cover for this subject today. So thanks a lot for your time.
Thank you very much. Yeah, so basically now we want to move on to a third topic that we have. Let's put it this way, because I think, as I mentioned already, I think the biggest issue that for the mining at the moment is access to the financing, because clearly it's a, let's put it this way, in terms of the business model. I mean, it's a long-term sort of sustainable business that people are investing in. It's a huge capex that goes into overall sort of a network maintenance and an upgrade, especially now. I mean, we're going to see it in the next sort of few months, and the hundreds of millions of dollars will be flowing into this sector. And unfortunately, I mean, to date, I mean, we did not have sort of any sort of major developments on that front. So basically, the miners has always been operating in a sort of self-sustaining model on the cash flow, trying to work around that. And this is what we want to discuss, sort of the scope of instruments, because what we see at the moment is that miners sometimes are not even aware that there's actually other side, the guys who are coming, let's say, from professionals to the banking, trading background, who are actually rolling out the products now and trying to sort of find the clients with whom they can develop this product range And this is where basically we want now to sort of highlight some of the developments that we see in the market. So let me sort of, one of the things that basically was interesting, I think we recently saw in news, it was, I think last week, it's the BitOoda did the instrument sort of the hash rate sale of one of our facilities in New York. And this is what I want to pass basically and add some comments for Ryan from, I think your sound is switched off. Yeah.
Thank you very much, Denis. I mean, first off, thank you very much for organizing this webinar. I hope everybody's been finding it useful. I found the first few topics really helpful for myself. And maybe to start off, I was really, the whole team here was really thrilled about the reaction that we got after that press release went out about the institutional hash power contract we executed with Greenwich. I think really the key that I want to emphasize before maybe going a little bit further into that product is another acronym everybody should be aware of when we're talking about hash power derivatives or swaps or options, is the CFTC and the NFA, which is the regulator here in the US for derivatives. Our approach in really building out this institutional market for mining related contracts is to make sure we put the regulatory aspect of it first. So all of us here at BitOoda are fully licensed with our Series 3s. We're registered with the NFA, regulated by the CFTC. So certainly be aware that, you know, there are certain regulatory grounds that these contracts fall under too. And I really think that set the foundation for institutions to start get more comfortable with, you know, entering into the mining space, seeing some of these new creative products that are coming out, and start interacting with them. From the mining perspective, really how this whole, I guess how this originated is after we registered with the NFA in 2017, we began going up to miners and talking to them about, you know, where their risks are in their business, you know, trying to get them to proactively hedge against their Bitcoin price risk using options or futures or forwards. And really got some incredible feedback from those miners that, you know, yes, they're certainly exposed to the price of Bitcoin fluctuating, but they're also exposed to Bitcoin network difficulty changes. So as Bitcoin network difficulty increases, their expected production goes down. And what we did is really in collaboration with the mining community here in North America, is started to develop some contracts specifically for those miners to help them hedge out those risks. So when we talk about financial services for miners, really it isn't just, you know, here's, you know, a charter trust where you can custody your coins, or here is a, you know, OTC desk or exchange where you can liquidate your Bitcoin into US dollars or other fiat currencies, which we can certainly do. But when we talk about financial services, it's really more of a comprehensive engagement where we work with the miners, we come up with risk management programs. We come up with bespoke products for miners to really understand what their risks are and develop products to help them mitigate those risks. And then we go through with executing and creating a market for those products. So maybe I'll pause there, and if you want to, you know, dive into any of that further, I'm glad to.
Yeah, yeah, I think this is let's put it this way, because we obviously see from a market, it's clearly some a new method for the miners basically to convert. Basically, they still sort of understand this sort of the underlying asset is the BTC, but they're actually in a way converting into the fiat before actually going to the trading. So that's, I see that is one of the things that could develop it. It's in a way, it's a competition for the guys who actually run on traditional sort of trading. And this is what I want to pass on to Neil to comment on from as a liquidity provider basically, and some instruments we're looking at. And then we can see the contrast basically and to see that what addition it brings on both sides. Yeah.
Thanks, Denis. Yeah, I think here at Blockfills, we actually echo a lot of what Ryan said. Number one, we kind of have two separate entities, one being offshore unregulated for our traditional liquidity pool. And then we have an FCA regulated broker dealer out of the UK, simply because they've just had a more stern stance and more active stance on crypto itself. We've been pretty active in this space for the better part of a year. Our first engagement really kind of started out with one of the largest hardware manufacturers in the world coming to us and letting us know that they wanted to kind of start to shift their geographical production of mining. And so as they did that, they wanted to utilize some of their balances to finance the growth and spreading of their production. So most of what we did came in the form of forwards and swaps, kind of as Ryan pointed out. This was largely, over collateralized, low cost financing. I do believe that we probably have the lowest rates on that anywhere in the marketplace, given what we know about our competitors. Then it kind of moved into some of these structured products, which I'll kind of use that term almost to encompass. A derivative really wouldn't fall into this category, but some of the swaps that Ryan might have kind of talked about might. We kind of look at this all as a structured product division of ours, and it's mainly because of, to Ryan's point again, these mining institutions will come to us and look for bespoke offerings. They want to know how to manage their risk. They want to look at, very customizable pieces of these trades. And so we worked in great detail with several of them, and I think we've accomplished quite a bit on the scale side. We would like to continue to grow this side of the operation, and we do think that companies like BitOoda, as well as CoinShares, whether it's an ETP, ETN, products like this in the future could bring added exchange traded liquidity. And something that's a little bit more transparent rather than an over-the-counter transaction. But, we have to start where we can start, and we'll grow from there.
Yeah, thank you. Yeah, I think that's a very interesting point about to mention, I think, because here, I clearly see, from interacting on the North American market, there is clearly a big drive on the structured products that basically you and Ryan just explained. On European space, what we see obviously, which was early adopters, let's put it on trying to get in, that we have ETNs basically in ETP. I think we have Moon in Switzerland, which is now I think 21 shares. I think it's CoinShares that as an instrument, and I think recently. Where Iconic is planning to roll it out, and also in Germany with the exchange traded notes sort of linked to a BTC. So in a way, is some alternative ways as well, to addition to selling the hash rate basically or doing a trading directly. It's actually trying to do a conversion into this products, which eventually can be, let's say, which more understandable. Because what I see at the moment, let's say, one of the points is that some of the banks, especially like banks who are trying to get more crypto friendly, I mean, they have an issue in terms of the middle back office trying to adapt, how to deal with sort of digital assets. So ETN and CTP probably can be one of the solutions for them. But for the miner side, I mean, at the end of the day, we just don't care. I mean, we just need to get access to the financing and trying to sort of keep continuing expansion sort of and develop and capitalize in the business. I wanted to ask basically Chris, because he has a very extensive sort of research on the mining sector, and I think one of the best ones to date, just to see based on his experience, I mean, what he saw interacting with miners, I mean, the level of sophistication and level of, let's say, sort of awareness of this, that how we want to sort of look at this or trying to address it. So please, Chris, if you can comment.
If you're referring to whether current miner sophistication is there in terms of having these markets develop fully, I think probably not in general. I think there are some players that are definitely sophisticated enough that already want to do this and are actively looking for solutions to do that. I think we probably have quite a while to go before we see widespread, fully liquid markets in these types of products. All the stuff that's available now is, like you said, it's over the counter. It's very often bespoke. So for this to get very widespread, we need standardized contracts. We need to figure out how we deal with non-delivery. Are you going to post up collateral. What is that collateral going to be? A lot of times, if you're looking for a product like this, it's because you need cash. So what are you going to post? Are you going to post your mining equipment? And what am I going to do with that if you don't deliver? So I think there are a lot of unanswered. Unanswered questions before we can get to a full proper liquid market for this. But considering the amount of people that are interested in doing this and that are building this right now, I mean, it's gonna happen. It's just a question of time. And I think it's nice now that we have a full 4-year period of no halving to sort of try this out without getting like a halving stuck into the middle of it right away, because that would probably complicate things and make things more difficult to structure than it otherwise would be. But the complexity is definitely a challenge. But I do observe that mining operations in general are getting more and more professional in the way they're structured, and they want to take less balance sheet risk than has traditionally been done. Traditionally, it's been a bit of a gambler culture in all this, which exacerbates volatility, which is not super beneficial in the long run. But if we get to the point now where you can get mining companies structured more like traditional commodities producers with a full range of hedging options, where they can take a lot of the risk out of this, hopefully it'll give more stability to the mining market itself, the mining industry itself, but hopefully also give a little bit more stability to the Bitcoin price, in that miners won't cause these exacerbated volatility moves to the upside when times are good, and then to the downside when times are bad.
Yeah, this is actually a very good point that we also had written down, basically to follow up, to add to that, to sort of spice it up a bit more. It's actually, it's a good point that about the collateral, the issue that at the moment, basically, that let's say the miners have the more sort of easier in terms of, let's say, structuring and sort of potential liquidation is obviously the BTC inventory, but then we come across the issue which is on a sort of a price volatility, and actually the potential risk of a margin call. And I think for the miners is a fundamental part that basically if you do a long-term planning, obviously you can use a BTC inventory, let's say, for the working capital sort of a revolving facility in a way that you're just trying to sort of meet sort of short-term, let's say, cash flow sort of needs. But if you actually do, let's say, the longer term planning, I mean, this is a very capex intensive business. And in terms of the payback, obviously, clearly with the current market volatility, and this is what I want to actually bring it back to the guys who are more on the trading side to make a comments, because at the moment, what we see, there is a lot of movements which have taken place because of a large sort of accounts sort of moving in, or there is actually some liquidation on the futures market that affecting it. And this is something that miners basically cannot sort of address, and sometimes they have so many things to worry about. So at the moment, if we look, and I come from traditional sort of banking and mining, let's say if you go on like gold, copper, and you do a hedging, for example, if I don't want to take, let's say, this whole exposure to the volatility and potential risk of a margin call, obviously I go like some collar strategy. But this is, let's say, the question to me now, that at the moment, let's see, there is potential need, for example, if a product like this is available, but then there's a question, is there counterparties on our side that's ready to buy this risk, and basically it will be reasonably priced for us, you know? So this is I want to actually pass to Neil and then to Ryan and Ethan. Can we start with Ethan actually, because I think you did not comment on that yet, but and then we can go in turns. Yeah.
Yeah, sorry, what specifically?
Basically, specifically on, if you could say, on price volatility, basically, and then a comment about, let's say, the collateral sort of issue with sort of to see how to structure the collateral side. Yeah.
So Neil can probably comment more on the volatility of the actual like Bitcoin, but one thing I do look a lot into is the volatility of mining reward. And so mining reward's a function of network emission rate, it's a function of difficulty level, it's a function of Bitcoin price. And so if you add all those together, then you start to get a very volatile asset class. So mining reward is actually about 3 times more volatile than the price of Bitcoin itself, which just kind of really highlights the need for these instruments to help miners hedge, because they're taking this massive risk by investing millions of dollars of hardware and then earning on their machines, but that revenue is very volatile. So in the future, it may not be worth what they expected it to be. So I think that the needs of these products really become, apparent when you start looking at that. So that's in terms of like the volatility. In regards to like collateral, I mean, for these miner-backed loans, I think miners generally want to collateralize their ASICs. It's preferable to them because they don't usually have a huge cash position. That's probably why they're going to a lender in the first place. But these ASICs are incredibly volatile themselves. So I've been tracking some of the prices on Bitmain, WhatsMiner, and these secondary markets, and the prices of the ASICs can fluctuate 10, 15% in a matter of 2 weeks. So as a lender, that's a huge consideration for you, is how do you collateralize those ASICs if you're not really sure the value of it in the future? And how do you adjust that on an ongoing basis? Do miners need to like top off their collateral every time the ASICs price drops and that sort of thing? So I think there's a lot of considerations for lenders to work through in the space on how to collateralize that.
Yeah, I think Ethan's got some really appropriate comments on the mining side. For me, this is like lighting gasoline on my fire here. This is the kind of stuff that I live for. So we could probably do a separate webinar entirely on stuff like this, but I'll try to keep it not only short, but condensed into maybe like 2 or 3 kind of little categories here. One, I would say first is on the mining side. I think if you look at the community of miners and or the community of hardware manufacturers, you are starting to see this shift that's going on globally, where if miners can't sell their equipment, hardware manufacturers can't sell their equipment, they're going ahead and they're mining with it. And then, whether we know or we don't know whether they're using it and then selling it, or they're just continuing to mine with that and new production is going out to new sales, the end result is clear that hardware manufacturers themselves are doing more mining probably than ever, and that will probably continue. So number one, you've got a growing player that has a position that has a different cost structure to mining than an underlying miner that's buying equipment with financing, hosting it at a site and having additional costs on top of that in terms of production. So the structure of the players and their costs and financing is starting to really change. And then with that comes the idea of, are we going to start financing more for players who have been credible, have been around for 2, 3, 4 years, that are just upgrading their equipment, that are in good territories at good sites, and have actually a legitimate cost structure to actually be successful at mining whatever it is they're mining. And so I think that we're certainly looking at a number of solutions with our structured products that are going to allow for collateralization in machines. But I think one thing that comes extremely important to that is, if you're going to ask a North American finance partner to finance a Chinese miner, you have no idea where they're hosting their equipment, you have no idea what their costs are, that's going to be really tough. However, there's a lot of great credible 2, 3, 4-year-old mining companies that are happy to be transparent about their balance sheet, about where they're doing their hosting and their costs and what machines they're using. All of those are inputs where we can actually figure out the likelihood of their success in the marketplace. And so I think that that's really important. And that's how we create layers of transparency and due diligence to actually successfully finance guys who might not have the balance sheet of a larger hardware manufacturing company. Then with respect to like liquidity products and trading and volatility, I actually would disagree that the volatility is stemmed from whether miners hold or don't hold. I don't think that, like, if you look at Deirdre's a brief discussion on a mining pool sending Bitcoin to an exchange and liquidating it, I think generally speaking, the biggest mining players are not selling a ton of BTC. They're using it as collateral to continue financing and doing business. And so I don't actually think that volatility is driven from an underlying player holding or selling BTC. I think it's around the financing that they've done with lenders. And so several lenders are going and using that collateral to lever their balance sheet and using derivatives as a component of that. And they're the ones getting liquidated as a result and managing collateral calls accordingly. So I think there's a little benefit to doing things over the counter, which is what we've done over the last year. And so we can manage margin calls a little differently than someone that's going to auto liquidate, a margin position on a derivatives exchange. And then I think that, several of these lenders, they don't properly manage risk like a clearinghouse would. They manage it like a lending book, and it's so swift to try to, mitigate risk because they're taking all of that risk themselves. I think a clearinghouse, which is a division of how our company works, each exchange needs to operate more like a clearinghouse as we go forward, but that's really like a retail venue. I think there needs to be proper clearing of these complex instruments going forward. And one of the things that Blockfills is introducing very shortly is actually a structured product around funding rates at derivatives exchanges. So what we'll do is we'll create a Bitcoin dollar swap that allows, it's really a repo market. So let's say miner XYZ is about to go on a margin call with me on my over-the-counter swap that I did. If it's going to take them longer to, for example, get BTC out of cold storage to manage their margin call with me, and they're not prepared for that, they might be able to come in with dollars that they have in their bank account that they can send to me at Silvergate or Signature instantly, or they can send me stable coins, and they'll be allowed to buy an 8-hour flexible period of repo funding, short-term, really low cost to actually manage their margin call. Those are things that I think, if you were to ask BitMEX, you'd find that they're very interested in. They were probably the first call when we launched our trade at settlement product to create structured products around funding rates at derivatives exchanges. So I think that as we create a liquid repo market and we create some swaps that are going to be actively traded, I actually think that there will be ample liquidity for listed streaming swap products, and the liquidity for ETPs, ETNs, to Chris's point, might take a little bit longer to do because I just don't think it's there yet. But I do think on the swap side, we can get there much quicker.
I think that's the interesting thing about the actual execution process, because clearly the getting out of a cold wallet, basically, or even just of a wallet. I mean, especially in the peak times, the chain, the queue basically forming quite substantially, in terms of transaction execution processing. I think the other thing that we probably for our next webinar can join and ask Fireblocks to join, because they have an excellent solution on the market, and this is I guess something which is an addition to that, where actually obviously you can on a signature or Silvergate you do automatic execution on one side, but on the digital asset side you clearly, a solution like a Fireblocks, you can obviously run it in parallel as well.
Yeah, you're right. That solution is without a doubt probably the premier solution in the space right now. In fact, our company, was myself included, I worked with Michael Shalov at Fireblocks in early days when he said, hey, look, we'll be able to do atomic swaps for Ether and Bitcoin, mitigating counterparty risk. And I said, hey, Michael, while that's great, that's what the blockchain was created for. I said, that's really not exciting in 2020. I said, what I'd really like to see is being able to mitigate counterparty risk for instant settlement between fiat and crypto. And that's when he said, well, how? And we've actually got an interview, a new fireside interview tomorrow with Fireblocks for their new campaign on the rolling out of this new product. And what it is It's essentially API connectivity to Signature and Silvergate's instant payment protocols, and we'll be all able to seamlessly settle 24/7 if you've got crypto in a wallet at Fireblocks and you've got an account at Silvergate or Signature. That's what is surrounding our Bitcoin trade at settlement product, which is a liquidity pool basically created for very low cost execution surrounding a benchmark rate that Tacit provides. So I think this is the future. Fireblocks has it. We'll probably be the first one to use this, and we encourage anyone that's doing serious business, especially overseas, that it might take geographical time differences or cold storage time differences to manage their business on margin calls, to consider working with Fireblocks and either one of those banks.
Well, thank you. I think we basically the hour almost passed pretty quickly. I just want to see, what we have in terms of questions. We obviously had quite a bit on halving about comments. Let me just see on the current hash rate. I think on the hash rate, if any sort of expectation, maybe I can ask Alejandro, maybe if you can have a guesstimate on or expectation to what you see coming through, and maybe Chris as well.
How much is going to decrease the hash rate?
Yeah, well, if you when we're coming into the halving, what do you think?
Well, if there's around 30% of the miners are S9s, then we probably will see all of those shut off, unless someone has connections in very, very cheap electricity, which will have to be in places like Iran or Venezuela, where it's dirt cheap to mine. There you could possibly still mine your S9, and if you change the operating system and stuff like that, but it's a lot of work, and it's not everyone can get there. So I believe S9s will probably drop off from the network, all of them. Another thing I wanted to talk about, Neil spoke about how manufacturers are maybe mining. It's actually a interesting point, because we've seen a very drastic increase in hash rate in the last couple of days. And if you know anything about the mining equipment trade, or right now it's extremely expensive to send miners across overseas because of the corona issue virus, and so what a lot of people are thinking is that a lot of the mining, the increase in hash rate has come from China, and specifically from manufacturers, because there's no other way to send the machines out. So this rapid increase in the last couple of days has there's a lot of speculation that our manufacturers are actually the ones pushing this up.
Okay. Yeah, so I think sort of to sum up, is any sort of questions that let me just quickly run through, besides sort of, I think the one other question we had is about a potential sort of upon the halving. Obviously, how it could be seen. Would it lead to actual more concentration in terms of, let's say, the mining pool, hash power, and in terms of, let's say, the big sort of allocation in terms of the big mining farms? This is other thing, and I think probably we can. I don't know if you want to comment, Alejandro, and then Ethan can or Chris can comment on that as well. What you see?
I think the pools that are most prepared for this situation will be able to live through it. But yet again, I come back to what I said earlier. I think this is a good opportunity for new players to come in. Nowadays the mining landscape has changed. You can get, like we've been speaking about, financing. You can hedge your position. There's a lot of new manufacturers in the market, so you can get different types of machines. So there's actually no real change there might be, with the decrease of hash rate, there might be, some pools which may grow in this small period of time. But the mining landscape hasn't really changed. It's only gotten better for new players to come in and for existing players to grow. So I don't see any centralization problem at all. No.
Can I ask, this is one thing which basically is an interesting comment, Nick. Comment on the status of mining liquidation in the current market. Heavy flow seems to have affected the Bitcoin price, especially during Asian hours. I think this is a speculation we're all looking at, in terms of the daily volatility. I don't know if who is the best to us. I don't know. Neil, Ryan, I mean, do you see this? Any comments or you can add to that?
The only thing I would say is that I think people underestimate how much this market is driven by the top trading players electronically. I think there's a lot to be said about when new funds come into the market. When frequently that the whole speculatory speculation on tether printing and money coming into the market. I wouldn't say I'm the best to answer that and know a firm answer on it, but it's certainly interesting. But I think people underestimate very much so who the traders are in this space, who's the best, and what they do and how they do it and how they trade and how that impacts the market flows. So I would just say that, and that I think people underestimate how the market's pricing is dictated by flows, and it could just be on exchange versus OTC, different times of day activity versus kind of like the last 8 to 10 hours. I really don't think it's all about miner liquidation. I think that would be not proper to assume that that miners small scale flow in the grand scheme of things have an overall large impact on the market.
Yeah, no, I agree with Neil on that front, especially on the point of how much influence electronic traders have on the market. That I think that's a great point by Neil. I guess the only thing I would add to that is one thing that we've been picking up on at BitOoda is just how close Bitcoin seems to trade with the S&P 500 since this COVID outbreak here in the US. And it kind of really seems like that's the one macro event that everybody's paying attention to right now. I mean, I know this is a mining specific conference call, but above and beyond the upcoming halving, it really seems like everybody's looking for this coronavirus situation to subside.
And Ryan, do you think that that's really just Bitcoin's correlation to risk assets in general, or really the S&P 500? I'd love your take on that.
Yeah, I mean, there really wasn't a correlation before this happened, but lately it really seems like tick for tick, Bitcoin is trading with the S&P 500. So I'm not sure what changed within that time period. Maybe you said it's a large electronic trader that has this sort of algo functioning right now. But I mean, this certainly wasn't the case before the outbreak, but it's something that we've been watching over the last few weeks play out. One thing I would say over the impact of the COVID outbreak on mining specifically is, as Alejandro alluded to, there was a disruption in supply chains for miners to be able to get their equipment and upgrade and get repairs. So that's how it's impacted the mining sector specifically. But aside from that, I agree with your points on the impact that electronic traders are having on the Bitcoin price.
Yeah, I definitely saw that correlation increase, and I watched it in real time. A lot of it, I was just blown away by it, and I was curious your take as whether it's really just this correlation that's happening to the S&P, or if it's kind of all risk assets getting liquidated, and so for that reason people were liquidating Bitcoin positions as well, just out of fear in general, or if it was something you thought would persist to the S&P in general. But yeah, certainly an interesting topic.
Well, as our founder Tim Kelly says, the only thing that goes up in a down market is correlation. So I mean, on March 12th when we really sold off, I mean, it impacted all markets. Like gold should be a safe haven, but it was also decreasing. People have to liquidate to cover their positions, and in other assets that they're trading. So yeah, I mean, hopefully that you start to see a real decoupling soon. That's what we're waiting for between Bitcoin and the S&Ps.
But also, just to elaborate on that, I mean, don't you think that it's also because a market is dried up a bit because of the events, and clearly that because we see it now because we execute and trades like more regularly now, we see that these sudden movements that are taking place up and down, this could run in the course of 2 minutes. You know, you can see the sort of a $500-600, you know, movement up and down. So it's clearly it's not a retail segment or miners trying to go sort of coordinated attack on the market. So it's clearly there's something happened. But I think hopefully it's just my take is that basically as a more sort of comfort, you know, to the market, and we see more inflows, then basically at least it's going to be more volume inside, and maybe this type of sort of volatilities will probably still exist, but with a bigger tickets, you know, like not 1,000, 10,000 BTCs at a time. Yeah. So I don't know, Ethan, do you want to add to that on the trading?
Yeah. I mean, I think Ryan covered it perfectly there. That's how we're looking at it too, coming into the halving. I guess before, I know we're running up on time here. I think before we end, I think one of the really important parts that Ryan brought up earlier is like around regulation on financial instruments. So would love to just touch on that quickly. I think what they're doing at BitOoda is really great, getting the CFTC, SEC familiar with hash rate as an asset class. We saw a ruling in Texas last week where the Texas regulators actually ruled hash rate itself as a security, not just a cloud mining contract. So I think all of us here on the call, as well as people listening, like if we can continue pushing, you know, this towards regulators in a friendly way, that's really what this industry needs is, you know, more education for the regulators, because we want to push forward great products for miners, and we don't want to let, you know, a few potentially cloud mining companies ruin these instruments to allow miners to hedge. So, you know, really wanted to highlight that point.
I think we have a comment here about Bitcoin repo swaps, but I don't know, Neil, do you see the comment here?
Hold on 1 second, I'm taking a look.
It's from Leon, yeah.
Sorry, is it an open question?
Yeah, I think it was an open question. Bitcoin repo swaps. I would like to hear a little bit more about how it works. Who takes the risk there?
The repo swap. Okay.
Yeah. And who is the customers, please?
Yeah. So actually, this will look a lot like a traditional funding rate, only it will be introduced as a swap rather than a rate you're forced to pay, right? So how the perpetual contract works is if you're long or you're short, depending on where the market sits and the calculations, you could be either getting paid to allocate on one side of the trade, or you would be paying to take the other side of the trade. And so what would happen in this repo swap would be you'd be paying to not get liquidated out of a position, or you'd be receiving payment to ensure that liquidation, right? And so basically what we're looking to do is just create, it's really going to be a buy-side feature, right? It's going to be, I'm paying for insurance or I'm not paying for insurance, and you can choose to take that, and how it's going to be collateralized or insured will be through BTC deposits. So you can come in and you can buy with dollars or stable coin because they're almost one and the same, and you can basically say I've bought credit, right? And that credit allows me to hold on to my exposure for the foreseeable future under the current circumstances. Now, if the circumstances were to change and the market were to continue to go down, or up for that matter, you would be able to purchase more insurance on that, right? And so when that occurs, more funding will be available in the Bitcoin insurance fund to collateralize each transaction. And all Blockfills is going to be doing is saying, we're giving you credit to maintain your position for some period of time. And if that position then is blown out, you will be liquidated like normal. This will just give you the ability to have flexibility in not being liquidated in the event that you have a large trade, it's not in a time zone or geography that you are active in, or you need time to adjust your position wherever it may be. So like you said, we see a lot of mining companies, especially maybe in Asia, that, you know, in our US session, they might not be awake and really monitoring this 100% of the time. They might need 8 hours or 12 hours or 24 hours to keep their margin requirements intact. And in fact, many of those things are negotiated in margin requirements in these bespoke products that are created. So I think that if you need to give them time, you need to give them an opportunity to buy insurance against that liquidation, and everything will be insured with Bitcoin in a transparent account at Fireblocks.
Okay. I think we're running over a bit. It was an interesting discussion. I think it's going probably on each topic, and we can go for specifically just for an hour or even more. I just wanted to wrap it up to thank everyone for joining. I mean, it was quite a short notice that we reached out to all of you, and it was very grateful that it was a very interesting discussion. I mean, in terms of the questions that we might not have answers, I mean, people can follow up, and we were just trying sort of to see if you're going to release sort of highlights, and maybe we can publish some additional follow-ups questions jointly. Yeah. So thank you very much, everyone, for joining, and yeah, have a good day and stay safe.
Thanks.
Thank you.
Yeah.
Thanks, everybody.
Thank you, guys.
Okay.
All right.
Thanks,
everybody.
Thanks, everyone.
Thank you.
Bye now.
All right.